Something is shifting in how Americans are dealing with income taxes, and it is not what most people think. This is not about hiding income in offshore accounts or disappearing from the system. It is happening in plain sight, through a small box on a standard IRS form that tens of millions of workers already fill out every year. A growing number of people are changing their W-4 withholding, often by claiming Exempt, which tells their employer to stop sending federal income tax to the government on their behalf. The result is immediate: a bigger paycheck every 2 weeks. The problem is what comes later. Online, this is being described as a tax strike, a revolt, a quiet rebellion against a system people feel is no longer working in their favor. And when you look at the financial pressure driving it, the frustration is not hard to understand. Inflation has been running above 3% year over year, while real wage growth has barely moved. Energy costs have been volatile. Housing, insurance, and food are all meaningfully more expensive than they were a few years ago. For millions of households, income is not keeping up with what it costs to live. But here is the critical thing that is being missed, and it is the point this video is built around. Changing your withholding does not change your tax obligation. The IRS operates on a pay-as-you-go system. Shifting when you pay does not eliminate what you owe. What feels like a smart cash flow move in January can become a serious financial problem by April, and potentially a much larger one in the years that follow. Let's go through exactly what is happening, why it is spreading, and what it actually costs. Part 1. What is actually happening? To understand this trend, you need to understand how income tax collection works in the United States. For most employees, taxes are not something you actively pay throughout the year. They are collected automatically. Your employer calculates an estimated tax amount based on your W-4 form and sends that money directly to the federal government before it ever reaches your bank account. By the time you see your paycheck, the federal income tax is already gone. That mechanism withholding is the foundation of how the U.S. tax system functions for wage earners. The strategy spreading right now is simple. People adjust their W-4 by claiming Exempt, which tells the employer to stop withholding federal income tax entirely. The immediate effect is that take-home pay increases. If you were previously having $400 per paycheck withheld, that $400 now stays in your account. For someone under financial pressure, that change feels significant and immediate. Here is the problem. According to the IRS, claiming exempt status is only valid under a very narrow condition. You must have had no federal income tax liability in the previous year, and you must expect no tax liability in the current year. That applies to a very small group of people, mostly lower-income workers with limited hours. It does not apply to most full-time employees. What is happening right now is that people are applying this status outside of those conditions, which means they are telling the IRS something that is not accurate about their situation. The most important thing to understand is what this actually changes and what it does not. It does not reduce your tax obligation by a single dollar. All it does is move the timing of payment. Instead of the money leaving in small amounts throughout the year, it accumulates as a balance that is due at tax time. That is a timing shift, not a tax reduction. And because of how the IRS penalty structure works, timing shifts that are not managed carefully can cost significantly more than the original obligation. Part 2. Why it is spreading now. To understand why this particular strategy is gaining traction right now, you have to look at the financial environment that is driving it. The math of everyday life in 2026 feels increasingly difficult for a large number of households, and the data backs that up. According to the Bureau of Labor Statistics, consumer prices have continued to rise at a pace that outstrips real wage growth. Inflation has been running above 3% year over year, while real average hourly earnings have increased only marginally. That gap matters in a very direct way. When prices move faster than income, purchasing power declines. People feel it in their grocery bills, their utility costs, and their insurance premiums, and they adjust their behavior in response. Energy costs have added another layer. Volatility in fuel prices does not stay contained to the gas station. It feeds into food distribution, manufacturing, and utilities. Even when prices stabilize at a lower level, the effects tend to linger because businesses adjust their pricing slowly on the way down. So from a household budget perspective, the pressure feels persistent rather than temporary. At the same time, there is a growing perception that government spending has expanded significantly, while efficiency and accountability have not kept pace. Whether that belief is fully accurate in every detail is somewhat beside the point. What matters is that it is influencing behavior. When people feel that the system is not delivering proportional value for what they contribute, they become more willing to question how they participate in it. That is exactly where this withholding strategy gains its emotional traction. It offers something immediate, more cash in each paycheck right now, without requiring negotiation or approval. There is also a psychological dimension that is easy to underestimate. Paying taxes through withholding is largely invisible. The money is gone before you ever see it. Once a person changes their withholding, and the full amount of their gross pay starts landing in their account, everything shifts. Taxes stop feeling like an automatic background process and start feeling like an active decision. That shift can be powerful. It turns a passive system into something that feels controllable. And once people start actively deciding when and how money leaves their hands, it opens the door to further experimentation even without a full understanding of what the consequences the real will be. Costs nobody is talking about. This is the part that most people who are considering this strategy either do not know or are choosing to ignore. Because in the beginning, nothing bad happens. Your paycheck is bigger. There is no immediate feedback from the IRS. The money is in your account. That silence creates a false sense of safety that can persist for a year or even 2 before the situation becomes difficult to manage. The first cost is the underpayment penalty. According to the IRS, if you do not pay a sufficient amount of your tax liability throughout the year, either through withholding or estimated tax payments, you are assessed a penalty. This is not a warning. It is a charge applied automatically when you file. On top of that, if you owe taxes and do not pay the full balance by the filing deadline, a separate failure to pay penalty begins to accumulate. That penalty can reach up to 25% of the unpaid amount over time. That is not a one-time fee. It is a percentage that compounds as the balance remains unpaid. So, if you owed $5,000 in federal income tax and did not pay it, the penalty alone could eventually add $1,250 to that balance before interest is even calculated. Then there is interest. The IRS charges interest on unpaid taxes at a rate that has been in the range of 6 to 7% annually in recent periods. The critical detail here is that it is compounded daily, not annually. Daily compounding changes the math in ways that are not immediately intuitive. A balance that feels manageable in April can grow meaningfully by October, and if it remains unaddressed into the following year, the compounding accelerates the growth of what is owed. Beyond penalties and interest, there is enforcement. The IRS has several tools for collecting unpaid taxes that can directly reverse the cash flow advantage people were trying to create. These include placing liens on property, issuing levies against bank accounts, and garnishing wages, which means the agency can instruct your employer to redirect a portion of your paycheck directly to the IRS. That is the exact scenario people are trying to avoid when they adjust their withholding. Enforcement can put you in a worse position than you started. There is a common assumption circulating right now that reduced IRS staffing makes enforcement less likely. It is true that the agency has seen workforce reductions in certain areas. But this assumption misses a key shift. The IRS has been significantly expanding its use of data systems, automation, and artificial intelligence to identify discrepancies and flag unusual patterns. According to reports from the Government Accountability Office, the agency is increasing its analytical capability even as headcount fluctuates. Fewer employees does not mean less visibility. It often means that the enforcement that does happen is more precisely targeted. Part 4. Why a tax revolt does not work. The idea behind a coordinated tax revolt has an intuitive appeal. If enough people stop paying at the same time, the argument goes, the system is forced to respond. Power shifts from the government to the people. In theory, it sounds like collective leverage. In practice, it runs into a fundamental problem. coordination. For a tax withholding movement to have any real systemic impact in the United States, participation would need to be massive, simultaneous, and sustained. Not thousands of people, not even hundreds of thousands. It would need to be in the tens of millions, acting in concert, over a significant period of time. What is actually happening right now is the opposite of that. It is a fragmented collection of individual decisions made independently, often based on incomplete information, and spread through social media without any central structure or coordination. That is not a movement with leverage. It is a dispersed set of people, each carrying their own individual risk. Here is the key dynamic that makes this dangerous. Enforcement difficulty scales with participation. If the vast majority of taxpayers suddenly stopped paying simultaneously, enforcement would become genuinely complicated. The sheer volume would strain the system's capacity to respond. But when participation is limited and spread out, enforcement actually becomes easier, not harder. The IRS can identify the subset of non-compliant filers, apply penalties consistently, and process collections methodically. The system is well designed to handle dispersed non-compliance. There is also a timing mismatch that creates an asymmetry of risk. Even if participation in this behavior were to grow significantly, the system does not respond instantly. Tax obligations are assessed over time. Enforcement actions take months or years to reach resolution. Policy changes move even more slowly, but the individuals involved do not get the benefit of that delay. They face their penalties and interest on the standard schedule, long before any hypothetical collective effect could materialize. Each person who adjusts their withholding is accepting personal risk today against the possibility of a collective outcome that may never arrive. Part 5. The broader economic context. Taxes are not the only thing creating pressure right now, and understanding this behavior requires looking at the full picture. Income tax frustration does not exist in isolation. It is interacting with energy costs, interest rates, and inflation simultaneously, and that combination is what is pushing people towards strategies they might otherwise avoid. Start with energy. According to the U.S. Energy Information Administration, oil prices have remained elevated in 2026 due to a combination of supply disruptions and geopolitical instability. Crude prices staying above $100 per barrel at certain points has downstream effects across the entire economy. Transportation costs rise, which affects food distribution. Manufacturing input costs increase, which affects consumer prices. Utility costs become more volatile. Energy is not one category of expense, it moves through every other category, and households absorb those effects whether they are aware of the mechanism or not. Then there is the interest rate environment. As of recent Federal Reserve communications, the federal funds rate has been held in the range of approximately 3.5 to 3.75%. Official statements continue to characterize inflation as above target. That puts the Fed in a position where both available paths carry costs. Keeping rates elevated makes borrowing more expensive across the board. Mortgage rates stay high, credit card interest increases, auto financing becomes less affordable. That reduces consumer spending and slows economic activity. But cutting rates too quickly risks reigniting the inflation that has already been difficult to bring down. There is no clean exit from that tension. For households, the result is pressure coming from multiple directions at once, not a single large problem, but a combination of elevated fixed costs that are difficult to reduce in the short term. Housing, insurance, debt service, daily expenses, and taxes, all competing for the same income that has not grown proportionally. When that happens, people look for any lever that provides immediate relief. Tax withholding becomes one of those levers, not because it is the right tool for the problem, but because it is accessible and the effects are immediate. Part 6. Property taxes, adding to the pressure. While most of the public conversation focuses on federal income taxes, property taxes are becoming an equally significant source of frustration and in some ways a more confusing one, because the logic behind them is less transparent to most homeowners. Unlike income tax, which is tied to what you earn in a given year, property tax is calculated based on the assessed value of your property and the budget requirements of local governments. That distinction matters because the two factors do not always move together, and when they diverge, the result feels deeply inconsistent to the people paying the bill. Recent data illustrates the disconnect. According to housing market reports, the average property tax bill in the United States increased by approximately 3% in 2025, reaching roughly $4,400 per year. At the same time, home values in many markets declined or stagnated. For the homeowner in that situation, the combination is difficult to absorb logically. Your asset is worth less, but you are paying more in tax tied to that asset. The equity side of the ledger is moving in the wrong direction, while the cost side continues to climb. The reason this happens comes down to how local government budgets work. Property tax revenue is largely determined by what local governments need to fund, not by what the market is doing with real estate values. If school budgets, infrastructure costs, and public services require a certain amount of revenue, that revenue has to be collected regardless of short-term fluctuations in home prices. Assessments may lag market changes, but the budget requirement does not disappear because values have softened. From a household perspective, this creates a cumulative frustration. Property taxes are a fixed, unavoidable expense unlike discretionary spending. They cannot be reduced by changing habits or shopping differently. They arrive on schedule regardless of personal financial conditions. When combined with income tax frustration, elevated insurance costs, and flat wages, the effect is additive. It reinforces the broader perception that the financial system continues to extract more from individuals, even when individual circumstances are not improving. That perception is one of the primary drivers of the behavior we are discussing. Conclusion: what is happening with tax withholding right now is not primarily a tax story. It is a pressure story. The withholding adjustment is a symptom of something broader, a growing gap between what households are bringing in and what it costs to maintain a stable financial life. Inflation reduced purchasing power. Interest rates made borrowing more expensive. Fixed costs like housing, insurance, and property taxes remained elevated or increased. When all of those pressures arrive simultaneously, people look for any lever that provides immediate cash flow relief. Adjusting withholding is one of the few that is immediately accessible, requires no approval, and produces a visible result on the very next paycheck. But the trade-off is consistently underestimated. The underpayment penalty, the failure to pay penalty, the daily compounding interest, and the enforcement tools the IRS can deploy, none of these disappear because the original motivation was financial pressure. They accumulate on the standard schedule regardless of why the payment was delayed. And in many cases, the cumulative cost of those penalties and interest outweighs the short-term benefit of the extra cash flow that motivated the decision in the first place. What felt like reclaiming control can end up costing more than staying on the original schedule would have. The idea of a tax revolt captures something real about the frustration driving this behavior. But the current version of it does not function as a coordinated movement with collective leverage. It functions as a series of isolated individual decisions, each carrying its own risk, made against the backdrop of a system that is better equipped to process dispersed non-compliance than most people assume. The real question is not whether you can delay paying taxes. You can. The question is whether doing so actually improves your financial position over time, or whether it simply moves the cost into the future at a higher price than you started with. Understanding the difference between those two outcomes is the most important thing to know before making that decision.